Ladies and gentlemen, good afternoon. Most welcome at our webinar. I will say the title in German, Steuerliche Besonderheiten am US-Markt für die Automotive und andere Hightech-Branchen. Ich darf mich kurz vorstellen, ich bin Guido Stock, ich bin der Regionalmanager in der Außenwirtschaft, der zuständig für Nordamerika und Südamerika ist. Ich freue mich wirklich, dass Sie heute Nachmittag dabei sind. I'll switch to English again. The US market seems very similar at the first glance, but there are definitely differences in many areas. One of these areas is the legal area, another area the tax area, and therefore it's good to see to it that one is prepared. In order to be prepared, it's good to obtain specialist knowledge from experts. Experts such as our tax experts, to be precise, the tax experts of Advantage Austria in Chicago. These experts are from Clayton McKervey in Detroit, and they will talk to us on two different important topics in the tax field. But first, I will hand over to my colleague in Chicago, to Julius Bosak in Chicago, and he will at first give an overview at the US automotive market. Julius, can you hear me?
Yes, I can hear you. Thank you, Guido.
Pleasure.
All right, ladies and gentlemen, welcome to Chicago. Thank you for taking the time and joining us today. In the next few minutes, I will have the pleasure to give you a very brief overview of the US automotive industry. The market segment is huge. I will only be able to scratch the surface here, but I hope that I will be able to give you some of the key points. First, I want to point out the importance of the US automotive industry for the US suppliers base. Oh, here we go. For the Austrian suppliers base, as you can see here, in 2016, Austrian automotive supply base and manufacturers have exported 1.5 billion euros to the United States. That is about 10% of the total export volume of the Austrian automotive suppliers. Puts United States in a second spot right after Germany, which accounts for about 50%. The 1.5 billion has remained flat from 2015. Also, in the United States, the automotive industry is very important and contributes a big deal to the US economy. As you can see here, on a global scale, the United States market is in second place after China, before Japan and Germany. Every major OEM with an international footprint is already here, and so are their suppliers, and in many cases also the suppliers of their suppliers. 2.25 million people are employed by the United States automotive industry. Those are your line workers, the OEMs, dealers, and so on. And that directly connects to another 5 million jobs. The sales numbers throughout the last year, since the dip in 2008-9, have steadily recovered, one sales record after the other. The question is, where is it going from here? As you can see in this overview, it really depends where you get your data from, with 17.47 million sold light vehicles in 2016, as I mentioned before, was a new sales record. Now for 2017, the latest data indicates a slight downturn. Year to date would be 2.2% minus. Now, there is no reason to worry, according to the experts. When you ask market research analysts, the sales numbers for 2017 should be anywhere between 17 million to 17.4 million. Manufacturing is running lean at about 90%. New car sales incentives are on the rise, as we can see in the media, but still under control. This was a major contributing factor for the downturn in 2009. The United States is part of the North American Free Trade Agreement, as we all know. It's currently being renegotiated by the new administration. Things in general are going good in the United States. Next, I want to just give you a brief overview of the markets and the main players on the US markets. The Detroit 3 were leading the segment in 2016, starting by GM, obviously in the lead still. Second place would be Ford, which is the first time that Ford, or the first time in many years that Ford has beat out Toyota in this segment. Ford is also giving us the best-selling vehicle of the United States market, which is the Ford F-150, followed by FCA in fourth place. The Germans, they are running the luxury segment. Here you have Daimler in the lead. The company on the move in the last few years has been Lexus, which now is in second place, closely following Mercedes. And in third place, BMW. Now, where do you find all these companies and, in general, the automotive industry? Traditionally, car manufacturing, as you can see on this overview, concentrating around the Detroit area in Michigan. With the arrival of German manufacturers and Asian manufacturers, a lot of the manufacturing capacity and the supply base has also developed and moved to the southern United States. And with the dawn of the self-driving cars, connected vehicles, more IT in our cars, you can see that there's a higher concentration now in the Silicon Valley in California. Now, California claims to be the new center of the automotive industry. This might be true for the IT participants and the new IT players, but certainly when it comes to a concentration of manufacturing companies to R&D and decision-making, we still say that Michigan and the area around Detroit would be leading in that segment. Next, I can talk about a few trends that have been shaping and influencing the US automotive industry. I won't be able to go over all these points. I want to pick up a few important ones. In general, you can say that these points that you see on this slide, every area here is an opportunity for Austrian companies to come over, set up shop, get feet on the ground, and contribute their technology and their know-how to what is already on the market. The first point here, shortage of qualified workforce. This is something that we have been hearing a lot and facing a lot of feedback that companies have a hard time finding qualified workers. This is on the one hand due to a lack of the dual education, what we know as apprenticeship. What is common in Austria and in Europe. This is something that a lot of companies, local and state governments, are working on to improve that situation. Specifically in the tool and die industry, this will be a major problem within the next few years. The average age of a US tool and die worker is about 55 years at the moment. Retirement will increase, and per year there's only 3,000 new qualified workers entering the market. On the right side you can see a statistic of workforce hours by the Detroit 3 in the tool and die segment. You can see between 2017 and 2019 what is needed will not be able to be filled. There is a $6 billion gap here, so huge opportunities for tool and die suppliers and manufacturers to come over here and set up shop and help fill that gap. Automation, that's pretty clear and self-explanatory. Companies need to reduce their manufacturing costs. A lot of the processes are now automated. and for Anlagenbauer and specialists in that field, also huge opportunities here. The remainder of these points are, as I said, pretty self-explanatory. The car needs to be lighter, the car needs to be connected, new materials are being used and looked for, new technologies. Everybody wants their car to have the latest gadgets, be connected. So if you're an Austrian company that wants to come over here and has technology that is new to the market, these are the areas where you can succeed. For Austrian companies that are already here, as Guido mentioned initially, the industry, the automotive industry, is different from many other industries. You need to have boots on the ground. Local presence is imperative. You shake hands, you seal deals, and these are some opportunities of trade shows in the United States to meet the right people in sales, to meet the right people in the development departments. The first two events are something that the Advantage Austria, the Außenwirtschaft Austria, are organizing. We would be glad to have you as participants. We try to help you and get to these trade shows and make those necessary connections to be successful here. If you have questions, I'll be available after the webinar. Thank you. That concludes my part. And
Julius, thank you very much. May I just briefly come in here, say really thank you for your brief presentation and nevertheless very informative presentation. And to our viewers, to our guests, I would like to say no need to take notes. We will send out copies of all presentations to you after the webinar. And if you have any questions, please use the system to let us have your questions in writing, and we will see to it that both Julius and our tax experts will let you have answers to your questions either immediately. We'll try to limit the question and answer session time-wise a bit, but we'll try to answer all those questions we can answer immediately right during the webinar. And those which we can time-wise not answer, we will try to answer at a later stage. So please do let us have your questions in writing through the system while the webinar is going on. Thank you. And back to Julius. Julius, you will be handing over, and let's then to Sarah.
Yes, now I have the pleasure to introduce our colleagues from Clayton McKervey, public tax accountant company we've been working with, and we've had great experiences. As Guido mentioned, it is important to have the right people helping you out in the market, and Clayton McKervey has certainly been one of these partners. We've heard great things about this company from Austrian companies so far, and Sarah will be talking a little bit about research and experimentation tax credits. Sarah, the show is yours. Thanks.
Thank you, Julius. I appreciate the introduction. I'll give a brief introduction of myself. I'm Sarah Russell. I'm a tax partner at Clayton McKervey. We are a local CPA firm in the Detroit area. We specialize in international tax, accounting, and assurance services with a big focus on helping foreign companies come to the United States, as well as U.S. companies who are looking to expand overseas. Today I'm going to talk to you about the research and experimentation credits. We'll give you a pretty high-level overview. We'll go over a few common misconceptions that are out there about the R&E credits in the United States. The regime is a little bit different than what you may be used to seeing in the European countries, as well as talk about what types of activities qualify and what types of expenses qualify. We'll go through a few examples so you can get an understanding of the types of savings that may be available, and then touch a little bit on some of the differences between the U.S. credits and what may be available in some of the European countries. So a surprising statistic that we find is that only 5% of all companies in the United States take advantage of the credit to the fullest extent allowed. And the reason being is that many of the qualifying activities are overlooked because business owners think of R&D activity in a traditional manner rather than in a tax manner. And so we'll go over what that means. We like to say that qualified research activities, in the traditional definition, it means it's new to the world. You're inventing something brand new. Maybe you're applying for a patent. But in the tax definition, it only needs to be new to you. When you think of it in those terms, it really broadens the type of activities that may qualify for this credit in the United States. So we'll go over a couple of, or about 10 credit myths that we find most commonly when we're talking to companies that aren't taking the credit, reasons why they think they shouldn't take the credit. The first one is, a lot of people say, well, the R&D credit is only for companies that invent something revolutionary. This isn't true. Really, it's something that needs to be evolutionary to you, an improvement in an existing product or process that you are undertaking may qualify. The regulations define research as activities constituting the process of experimentation intended to eliminate uncertainty. And that's the key phrase. If what you're doing is intended to eliminate uncertainty, it is possible that you have qualifying activity. The second myth is that the credit is only for companies engaged in basic research. The credit also extends to companies engaged in the applied sciences, which is something that many companies perform on a daily basis. The third myth that we hear often is that it's not available for companies that fail in their research. And in actuality, in the United States, failure in an experimentation process is pretty hard proof that what you're doing is qualifying activity. So when we're out there talking to companies and we're looking at what activities qualify, if they say something has failed, it's a pretty big bright light for us to say you probably have qualifying activity. Fourth myth, the credit won't help my company because my company is not profitable. Well, this is true. The credit is not a refundable credit in the United States. We typically will talk to companies if they're in a net operating loss position and look and see when those net operating losses will be fully utilized, and to determine when it makes sense to think about taking the credit, because the credit is you can carry the credit forward 20 years. Fifth myth, a lot of people will say, well, the R&D credit is only for big companies. I'm too small, I won't benefit from it. We have companies with $5 million of revenue who are benefiting from the credit, all the way up to $100 million in revenue. So the credit is available for companies of all sizes. In fact, recently regulation was passed where the credit is available for startup companies to offset payroll taxes rather than income taxes, and we'll get to that a little bit later. The R&D credit doesn't help with state taxes. Something that's a little bit different in the United States compared to the European countries is that we have a federal level tax as well as a state level tax, and about 35 states in the United States do in fact have a research and development credit available. So the credit could help you offset state taxes as well, depending on where you're doing business. 7, the R&D credit's not a big deal because our company is already getting a deduction. In the regulations in the United States, you can actually take a reduced credit and a deduction at the same time. So you're not adding back the expenses for purposes of calculating the credit, you're getting the benefit of both. Number 8, the R&D credit is not available to my company because our research is funded by the government. This isn't a space that we practice too often in, but depending on what type of funding you're getting by the government, there are some planning opportunities that exist where you may still be able to take the credit. 9, the credit is for increasing research, and since my spending is flat, my company is not eligible. This is a tricky concept because while the credit is called the credit for increasing research activities, the way the calculation actually works is that you often will still enjoy a rather substantial credit even in years where your spending is flat. So it's worthwhile to go through the effort to determine whether or not you have any credits available. And number 10, manufacturing must be done in the United States in order to qualify. This is not true. If your engineering and design work is done in the United States, you will likely have qualifying activity. The activity that needs to be done in the United States is not the manufacturing. The manufacturing can be done anywhere. Julius talked a little bit earlier about the tool and die industry, and we have a tool and die company that actually designs tools and has them manufactured in Korea, but they are still getting a pretty substantial credit here in the United States. So this is just a very high-level example. We deal with a lot of system integrators here in the Detroit area, and we have a client who has annual sales of $30 million, qualified labor of $2 million, and qualified supplies of $2.3 million. And they were able to take a credit of $154,000. For a company with $30 million in sales, that translates to be a pretty substantial tax savings for them. A couple other examples. We have a S Corporation with annual sales of $18 million and qualified labor of $1.2 million. Before they talked to us at Clayton McKervey, they were taking a credit of $80,000, but this is a good example of a taxpayer who was not utilizing the credit to the fullest extent allowed under the law. Once we came in and looked at some of their supply costs, we realized not only were they underestimating their qualified labor costs, but they weren't taking any credit on the supply costs. And so, at the end of the day, they ended up with a tax credit of $560,000 instead of $80,000. So these are just a couple of examples of clients that weren't taking the credit before or were substantially underutilizing the credit. And so it's important that if you're looking at an R&D credit in the United States, you really are working with somebody who understands all of the regulations. I'm not going to go through all of these examples. Those are just a couple that we wanted to touch on. So a couple of key points on the R&E credit. It's governed by the Internal Revenue Code under Section 41. It's based upon qualified research activities, which we will get into in a few slides. There's 3 types of expenditures that are eligible for the credit: qualified labor, qualified supply costs, and contract labor. Refunds received from the IRS are tax-free. However, the credit is not tax. It's not a refundable credit, which is a little bit different. I think a lot of credits in the European countries are refundable, which means you could have losses and not have any tax liability and still take a tax credit and get a refund. In the United States, the credit reduces your tax liability, and if your tax liability is 0, you would carry that credit. You would carry forward that credit up to 20 years. From a logistics standpoint, the credit is filed on Form 6765, and as I mentioned earlier, more than 35 states have a similar program in addition to the federal credit. So in 2015, there was new legislation passed that went into effect January 1st, 2016. Prior to that, the credit was not made permanent. It was extended every year, a lot of times at the last day of the year when Congress was passing a new tax bill. It would get they'd sneak it in there at the end, but taxpayers weren't able to plan for it properly during the year. So beginning in 2016, the credit was made permanent. Taxpayers can now plan for it and make sure they're gathering the documentation that would be required for it. They turned off alternative minimum tax for companies with average gross receipts over the last 3 years under $50 million. And this has really increased the significance of the credit in the small business world, where before this happened, a taxpayer may be able to reduce their tax liability to about 20%. Now you could bring it down to, in some instances, to 7.5%. So it really changed how much companies were utilizing the credit. I mentioned that startup companies may claim the credit against payroll taxes for taxable years beginning in 2016. There are some pretty specific rules around this, but you could take a credit up to $250,000 against your payroll taxes, as long as you meet the requirements. There's an alternative simplified credit. The election is now allowed to be made on amended returns. In the past, you had to make that election in the original return. And what that did is it allows companies who have not previously been documenting or gathering information to determine what their credit could be in years where they were incurring losses, and made it a lot easier. The simplified credit requires a lot less information from previous years. You only have to go back 3 years rather than potentially to the beginning of the company. So we'll skip ahead and talk about some of the qualifying activities. First, I want to touch on a couple of issues specific to foreign-owned companies. There's control group rules in the United States which could impact the utilization of this credit. Foreign parent companies' average gross receipts need to be considered to determine whether the U.S. entity qualifies for the AMT turnoff. Typically in the United States, control groups do not include the foreign parent companies, but in this instance, in this definition, they do. But what that means is that research conducted in the United States but paid for by the parent company is not considered funded research, because the transaction between the parent company and the U.S. subsidiary is disregarded. So you could be doing engineering and design work here in the United States for the parent company and for patented technology that will exist in Austria, but still be able to take the credit here in the United States. So some qualified research activities is the development or improvement of business components, which is a product, process, technique, formula, invention, or software. There's technological criteria. Process of experimentation must fundamentally rely on principles of science, including physical, biological, engineering, chemical, or computer sciences. A lot of our taxpayers here in the Detroit area will qualify under engineering. We don't deal with a lot of pharmaceutical companies, but we certainly have a lot of intensive engineering products that are being built here every day in the Detroit market. Elimination of uncertainty. The information sought must be intended to eliminate uncertainty, which exists at the outset if the available information does not establish the taxpayer's capability of developing or improving the business component, method of developing or improving the business component, or appropriate design of the business component. This is a key component of determining whether or not you have qualified research activity. And then process of experimentation is the evaluation of multiple alternatives, including developing and testing hypotheses, modeling, simulation, and systematic trial and error. It goes beyond the lab and includes both conference room and shop floor experimentation time. And the research must substantially relate to new or improved function, performance, reliability, or quality. Examples of qualifying activities: providing custom control and automation solutions for various applications, developing new functionality or performance to meet customer specifications, developing prototypes or models, developing new technology, streamlining internal processes, improving processes through robotics or other types of automation techniques, implementing automated systems. There's several different types of qualifying activity, so you really want to make sure that you talk to a provider and understand if what you're doing would qualify. Qualified research expenditures, as I mentioned, include wages of performing, supervising, and supporting qualified activities, supplies cost to fabricate prototypes or items consumed in the R&D process, and fees paid to outside consultants, subcontractors, engineers, software developers, etc. Utilization factors. So I mentioned that if you have net operating loss carry forwards, that you won't be able to utilize the credit. So we usually come in and look at projections, and if about 2 years before the taxpayer is projecting to be taxable is usually the time we start gathering the documentation and focusing on determining how much the credit will be. Unlike most European R&D credit regimes, as I mentioned, the credits here in the United States are not refundable, but they can be carried back or carried forward 20 years. There are statutory deadline considerations, and as I mentioned, this is especially important with foreign-owned companies. There's controlled group considerations to think about. There's a couple more examples in the back of these slides that you can walk through on your own. I'm not going to do that in the interest of time, but just real quickly, some required documentation to take the R&D credit, job descriptions for each employee, having a good time tracking system for what the employees are working on is important. If you don't have that, you need to go through and have employees sign sheets and sort of confirm that the time they're spending is qualified, and then gathering the supply cost per project and contract research costs if you have it. So with that, I'm going to slide it over to my colleague here, Alex Martin, to talk about transfer pricing.
Thank you, Sarah. I think that was really lots of valuable information. Thank you for also pointing out the differences to our European system. I think interesting to note, of course, that you don't need to necessarily manufacture the products in the US. It's sufficient if research is carried out in the US. I believe that should have been interesting for our guests, our listeners, and with that I would like to hand over to Alex Martin, who will be talking to us about a very hot topic. Welcome, Alex, about transfer pricing.
All right, well, thanks so much, and thank you for everyone for joining. My name is Alex Martin. I've been a transfer pricing specialist for over 20 years now, and not just on U.S. issues, but also on a global basis too. You may or may not have come across transfer pricing before, but I did want to talk through why is transfer pricing a hot topic for not only Austrian and U.S. companies, but on a global basis. We'll talk about some best practices that we've identified over time for addressing transfer pricing issues, and we'll also talk about some recent transfer pricing developments that certainly affect both Austrian and U.S. companies. Let me just jump in with an example here. Let's say we've got an Austrian parent company that makes auto parts, that sells auto parts to a U.S. subsidiary and also charges a royalty, and the U.S. company in turn sells to retailers. Well, there comes a dilemma for every multinational company in that if the Austrian company charges too high a price, the IRS has a problem. If the Austrian company charges too low a price, the Austrian auditor has a problem with it. So if you're a company with cross-border operations, if you're too generous on one side, you're going to have a problem on the other side. So all that comes down to, from a big picture perspective, transfer pricing affects where taxes are paid on a by-country basis. So therefore, it's a very big deal. So what does this mean in practice? Well, transfer pricing rules are effectively driven to make sure that all multinationals pay their fair share of income taxes in every country they operate. And it doesn't matter if it's goods, services, royalties, loans, what have you. These rules are broadly similar worldwide. And today, over 100 countries now have transfer pricing rules on the books. And what is the correct price? Well, it should be the same price you would charge as if you were unrelated companies. So in other words, the ownership doesn't have an impact on what the price is charged. We'll go into a little more detail about how these rules apply on a global basis, but big picture, that's where you should start with. So why is this a big deal now? Well, certainly more companies operate internationally. And high-profile multinationals like Apple, Starbucks, and a number of other major companies have all been criticized for shifting profits offshore. So while certainly the big companies hit the news, more and more companies, even down to the middle market level, are affected by transfer pricing at the end of the day. And it's also a very high return on investment for tax authorities. You're not arguing about, let's say, specific tax deductions. You're actually being accused of shifting profits offshore. So what we're finding now is that middle market companies, including startups, are being audited more regularly. And the IRS in particular has unveiled a new transfer pricing strategy to focus on foreign-owned U.S. subsidiaries. And that may impact a number of companies that are planning on establishing a U.S. operation or have one in place already. So their argument from a high level is that U.S. subsidiaries should be earning profits, or there may be a transfer pricing problem. So what happens if a transfer price is too high? So let's say, again, the Austrian company charges too high a price for auto parts and royalties, which leads to small profits or losses. Well, here's where things get a bit ugly. This is a very expensive issue. Let's say, for example, the IRS comes in and says, you know what, you should have been earning $10 million in profit. Well, under U.S. transfer pricing rules, and this is broadly the same everywhere, you will owe an additional tax on the taxable income adjustment, so in this case, $3.5 million, and if the dollar amount is large enough, you can owe non-deductible penalties of 20% on the additional tax owed. So this gets very expensive very quickly, and it's also a great revenue raiser from a tax auditor perspective. So while we're focusing on the US here, it actually would apply in Austria and other locations as well. In the US in particular, once the transfer pricing adjustment gets to 20 million or more, they're 40% penalties. So that being said, what are some best practices that may apply, and why do companies get in trouble in the first place? Well, here's another example that we've seen quite often, where a parent company in, let's say in this case, Austria, sells parts and also provides management services to a U.S. company. And the pricing they apply in this situation creates a loss. Well, where does this happen? Well, a lot of times companies aren't necessarily thinking about transfer pricing because that's not how they run their business. For example, but tax authorities have a very different perspective. Let's say the Austrian company has a cost plus 30% policy. You may ask, well, where did that number come from? Well, there's not necessarily a clean, concise answer there. Sometimes we've always done it this way, and next thing you know, you've got a transfer pricing issue. Sometimes companies are focused on, from a day-to-day perspective, one borderless business. But again, tax authorities are only focused on the profits in their specific country, so there may be a disconnect with the two. And third, which may be a bit surprising, what would happen if the plant manager's bonus is affected by transfer pricing? Well, quite often what we see is that the transfer price is overcharged because the plant manager in this situation gets a higher bonus by charging too high a transfer price. All three of these issues, or typical situations, lead to losses, in this case in the US, and frankly causes heartburn from an IRS perspective. All right, well, what are some best practices? Well, if you're setting up shop in the US and you have a subsidiary, the IRS is fairly pragmatic or practical in this situation. They are primarily focused on how much profit you are earning in the US. So they may not know anything about your company, they may not know anything about the transactions, but they do know how much tax you've been paying for the last couple of years. And so that may come from tax returns, or which can be quite detailed. But at the end of the day, if you're running losses in the US, in your US subsidiary, or your minimal profits, well, that's going to be a red flag from an IRS perspective. Conversely, from an Austrian tax authority perspective, if you're earning really high profits in the US, well, they're going to have an issue from an Austrian tax audit perspective. We find that a best practice is to focus on earnings before interest and tax, or EBIT, sometimes called operating profit, as a percentage of net sales. It's a good rule of thumb to work with, and it's normally we find the best way tax authorities identify their targets. So, and just to be clear, these are for annual profit results, and they do look at all open tax years. Now, what do companies do to defend themselves from transfer pricing audit? Well, typically what is done is what's called transfer pricing documentation. Like we were saying before, they may not know much about your company, and transfer pricing documentation, which is can be a fairly thick report, is the company's opportunity to explain and justify why the transfer pricing is correct. In general, it comes down to explaining how the business operates in both Austria and in the US in this case, how industry factors affect the business, look at the financial information and intercompany transactions, whether it's royalties, loans, goods, services, what have you, and then show transfer pricing is arm's length through economic analyses. Sometimes number 4 is quite often the tricky part. But again, like we were saying before, Austria and the US have similar transfer pricing documentation rules, and we strongly suggest as a best practice to make sure that the transfer pricing reports have the same argument and the same analyses on both sides of the border. But just to be clear, to avoid penalties in the event of a transfer pricing adjustment, you have to have a transfer pricing report prepared by the time a tax return is filed. Now, let's be clear, if there's no transfer pricing adjustment, there's no additional tax. This is where best practice here is to make sure that the IRS, or the Austrian tax authority in this case, are comfortable with the transfer pricing and walk away. Sometimes we find that, especially for new subsidiaries, maybe the risk isn't quite so high as with an established subsidiary, but sometimes a profit benchmarking study can be a good way to set pricing on a go-forward basis. Now, I'd just like to leave you with a couple U.S. transfer pricing takeaways. The IRS now has a 2-year audit roadmap process for transfer pricing. Generally speaking, they're going to look at your tax returns, maybe do a little bit of research on your company, but they're not necessarily going to have a good, thorough background on how you run your business day to day. This year in particular, they're focused on middle market, foreign-owned distribution companies. We're seeing that expanding into some U.S. subsidiary manufacturers as well. They are specifically targeting automotive companies, and that's for countries all over the world. And again, red flag is losses or small profits over an extended period of time. Transfer pricing documentation is your first and best opportunity to avoid an audit in the first place. You want to explain your transfer pricing and why it's correct on your own terms. And again, the IRS rules are broadly similar to what you have on a global basis. So, and again, rule of thumb, look at the profit margins of subsidiaries over multiple years, all open tax years, and you'll be ahead of 90% of the people out there. Now, it's not just U.S. rules that are in play here. There's also some major changes from a global perspective. The Organization for Economic Cooperation and Development, or OECD, that's it's similar to the UN, except it's more focused on international issues. The OECD transfer pricing guidelines are used as a basis for transfer pricing rules on a global basis. So effectively everywhere other than the US, but the US rules are consistent with the OECD rules. Given all of the outrage over big companies shifting profits to low tax jurisdictions, they've implemented what's called a base erosion and profit shifting program. This is happening in real time right now. For the largest companies, and we're talking revenues greater than 750 million euros, there are the most changes, but effectively it's a giant step forward in terms of transparency, because every tax authority everywhere can understand how much taxes you're paying and by country. So they have something what's called a master file and a local file. A master file has a high-level explanation of the business. Each local file explains how things work in a local subsidiary basis. And again, US, Austria, and over about 75 countries are applying these standards. What would you see in these global transfer pricing documentation standards? If you've been involved in this area before, this is again, a much higher standard for what would be acceptable transfer pricing documentation, but effectively it's an explanation of important drivers of business profit, a supply chain overview, a description of intangible property, and really a very thorough explanation of where key functions are performed, where major risk assumed, and where assets are on the global basis. And the U.S. documentation hasn't specifically adopted this master file approach, but really the documentation rules are consistent with this new master file requirement. Well, and sorry, just to clarify, although these rules were largely focused on the very large companies, Austria actually has a much lower threshold of companies with revenues greater than 50 million euros are required to have the master file when under a transfer pricing audit. The local file, in turn, provides more specific details on, sorry, let me jump ahead here, is specifically focused on the local country transaction. So if you had an Austrian parent with master file, local file, the local file will have a explanation of what happens in the U.S., what transactions are involved in the U.S., and why the company is paying arm's length prices for whatever transactions are in play. Again, while the U.S. doesn't specifically have the local file requirement, these rules are consistent with U.S. documentation rules. So again, best practice, make sure they apply to both sides. With that, I am going to, there's some contact details for me, but I'm going to turn it over back to Chicago and Austria, but thanks for your time.
Thank you very much. I think this is Austria calling. Thank you, Alex. I think, again, very informative, especially important documentation, as I learned, and our viewers learned. And I think important that you pointed out to us what makes the IRS heart burn, and subsequently might cause you, our viewers, a lot of heartache. So important to know what to look out for. And also, I believe also important to know that the OECD rules also correspond more or less to the US rules. So lots of valuable information. Many thanks. But I would like to ask Sarah and you to stay on, because we will still have the opportunity, or would like to have the opportunity to ask questions. Again, to our viewers, to our guests, we'll be sending out copies of all presentations. We'll also send you a link to a film of our webinar of today, which we will post on YouTube. And as I mentioned earlier, if you have questions, please let us have your questions so that Sarah and Alex and perhaps also Julius can answer these questions. So questions most welcome. I understand we have some questions already here. Some questions we received. May I just start with a question regarding transfer pricing, which we have been asked. It says, what can companies with new US subsidiaries do to establish transfer pricing? I think that's a question for Alex.
Sure. What we find has been successful over time is that a profit benchmarking study is one way to set a certain level of profit or a target level of profit going forward, and it's something that a multinational company can rely upon in the early days to make sure that we've got at least some explanation of why the profits and the pricing are reasonable. Like I said before, the IRS is largely pragmatic here, and if you're showing some level of profit with some analysis behind that, you're going to be well ahead of the game as a new subsidiary.
Thank you, Alex. I believe this will answer. Has answered the question. Another question we have received, I think that's for Sarah. What changes to the credit are included in the tax reform bills, Sarah? Would you be able to answer this question, please?
Absolutely. Currently, there is no change to the credit in any of the bills that are in the House or in the Senate. The biggest change you'll find is, if corporate tax rates decrease from 35% today to 25%, the value of the credit may decrease. If you're looking at bringing your tax rate down from 35% to 7.5%, that's much more savings than 25% to 7.5%. I don't think that 7.5% floor is going to change based on the mechanics of the credit calculation, and there has been no proposed change in any of the regulations surrounding the credit. So we think it's here to stay.
Thank you, Sarah. Very, very clear. Another transfer pricing question, I believe. How do you get a refund from the Austrian tax authorities if the IRS issues a transfer pricing adjustment, Alex?
This is where transfer pricing audits turn into multiple-year issues. If the IRS makes a transfer pricing adjustment, the Austrian tax authority does not automatically give you a refund. Under international tax treaties, the IRS and then Austrian tax authority would need to fight it out. Unfortunately, since transfer pricing audits are so fact-intensive, quite often these debates or disputes can go over 6, 8, 10 years before you get relief from double tax. So, long story short, to avoid double tax, you want to avoid a transfer pricing adjustment in the first place.
Again, thank you, Alex. I think seeing the tax authorities fighting it out might be interesting, but maybe nevertheless not too amusing. Yeah. Another question here regarding tax credits. Again, can the credit reduce my tax burden Sarah?
So I think in a lot of the European countries, I have found that either the credit is refundable, or if it's not refundable, it can reduce your tax to zero. That's not the case in the United States, since we're not working with a refundable credit regime. You can't reduce your tax rate to zero. And I mentioned the floor is, our rule of thumb is about 7.5% effective tax rate. One thing I didn't mention, but it is in my slides, is that you can typically expect for every dollar of qualified expenses, the credit is worth about 6.5%. So if you had $1 million of qualified expenses, your credit would be about $65,000. That's in pretty general terms, but it's a pretty good rule of thumb.
Thank you, Sarah. And I think we will end with this last question here. We have more questions, but we'll end with this. Other questions will be answered in writing. What legal agreements are required for cross-border transactions? I think that's one for you, Alex, again.
Sure. In our experience, the best practice is to have an intercompany agreement between when you're establishing transfer pricing. It's just one of those additional facts that help explain your story to tax authorities, and they do ask for it. So it's one of those things that really can make the difference between a transfer pricing audit and having the tax authority walk away. At the end of the day, when you come to a transfer pricing audit, you just want the tax authority to walk away and go get somebody else.
I think that's the perfect ending for our webinar, the tax authority walking away. Maybe not for Sarah, but surely as far as Alex and our listeners are concerned when it comes to transfer pricing. Yeah, and I think I would, please.
That's our specialty.
Please, Alex.
I'm sorry, that's our specialty, to get the tax authority to walk away.
That sounds good. Yeah, and on that happy note, I think we'll end the webinar. As I mentioned earlier, those who have handed in questions which haven't been answered now will receive answers in writing at a later stage. And that leaves me with the task of thanking our tax experts from Clayton McKervey, Sarah Russell and Alex Martin. Thank you very much, Sarah. Thank you very much, Alex.
Thank you for having us.
I appreciate it.
A pleasure. And also to thank my colleague, Julius Bosak at Advantage Austria in Chicago. Thank you very much for organizing our webinar today. Yes.
And also from my end, thank you for Sarah and Alex. Looking forward to the next time.
Beautiful.
Great.
Ladies and gentlemen, dear guests, I'm also looking forward to next time. I hope our webinar has been useful to you. And yes, see you again. Thank you.